Tim Lawless, mate, of CoreLogic, head of research over there, mate. Welcome to the Scouting Australia podcast.
Many thanks, Sam. It's great to be here.
Absolute pleasure to have you on, mate. It's a funny thing on the weekly news bulletins, mate, that we do weekly on every single Thursday. I quite often quote both yourself and Eliza over at CoreLogic, mate. So it's great to finally have you on here and actually be chatting about things one-on-one with you.
Oh, good to see you, mate. I'll have to tune in. And Eliza Owen, absolute legend as well. So I'm so glad you're featuring some of our content.
Definitely, mate. It'll be at least every couple of weeks, mate. We've got an article of you guys in there, and it's always really good, mate. So I appreciate on your end sharing the content that you guys do as well, mate. It goes a long way, and obviously staying very educated in this game is really, really important. So, mate, thank you once again.
Absolute pleasure, mate. Yeah, we're putting a lot of content out there, and we're kind of at CoreLogic drinking from the fountain of data. So there's always something to talk about. There's always an update. So we like to keep it nice and fresh. That's
it, mate. That's it. I see you on the socials a lot, mate. You're pretty good on there as well. It's good to see, mate. If you wouldn't mind, can you give anyone who doesn't know about yourself or even CoreLogic, do you want to give us a bit of a shout out, I guess, of what you do, over there, both your position and obviously what you do over there at CoreLogic as well?
Yeah, sure. Well, CoreLogic is a data and analytics company. We focus on property markets specifically, but our clients are really broad ranging. So they range from real estate agents and agencies who use our data to get an idea of what to list a property for and look at marketing histories of properties. We work a lot with the banking sector, more from a valuations perspective and risk management or mitigation, looking for opportunities. Lenders mostly use us for valuation estimates, and our valuation platform is called Valex. We also work a lot with governments and policymakers, consumers as well, valuers, mortgage brokers. So yeah, the list kind of goes on. Any industry that has a direct or indirect relationship with property, that they're generally looking for data. And our focus is to collect data from everywhere we possibly can and then bring it all into one centralized place. So for me and my team, my team of researchers, we have this, I guess, dream job where we're trying to make sense of what it all means and explain it to people. So in many ways, we're storytellers. But it's not just about the property data. We also look at economic information, demographic trends. We look at supply, demand, values, volume, anything that's important to the evolution of the market and trying to work out what's going on.
Definitely, mate. Definitely. I think it's a good way to put as well, the way you kind of wrapped up there, especially with today's topic that we're going to be chatting about with interest rates. But just for a final note, there, anyone that obviously has heard of RP data, which is probably pretty much every Australian investor that's out there, because everyone knows what it is, right? That's obviously what CoreLogic is. RP data is a spin-off of CoreLogic is the data central firm, right? And then RP data is obviously breaking that down from the property investment side.
Yeah, kind of. If I could just diverge for 1 millisecond.
Yeah, let's go, man.
RP Data was an Australian company founded by a gentleman named Ray Catlin in Queensland back in the 90s. And it grew to a stage where it actually got acquired by a company called First American that became CoreLogic. And we became part of a much larger global organization at that stage. That was back in about 2007, 2008. We listed on the stock exchange.
Yeah, right.
So yeah, RP Data is still our flagship product, but the company's brand is CoreLogic.
Yeah, very interesting, mate. Very interesting. If you don't mind me asking as well, how long have you been there for? Because yeah, RP Data is one of these things been kicking around for years, right? Like it's almost forever. It's the OG, real data source, I think, of property professionals and private investors out there as well from the very start.
That's good. Well, I've been here since 2007, so
okay,
17 years, 16 years. And before that, I was at Colliers International. I ran their research team. But before that, interestingly enough, I was actually at RP Data when it was a very small, privately owned company. So yeah, I've kind of come back to a company that was on a massive growth trajectory and just ridden that wave, which has been completely awesome.
That's awesome, mate. That's awesome. How good. Well, mate, we appreciate the data you put out there and obviously all the stuff that you legends over there put together. And mate, today's topic, we're talking all about the interest rate. So obviously interest rate results came out this afternoon. Only it was about an hour before you and I are chatting right now. So mate, I'd love to dive into that with you. I know you always come out and you give your projections and your reasons why you think different things have come out the way they are. And mate, I'd love to unpack it with you today around current interest rate. Obviously, they got the announcement that got released today, and then reading deeper into what the RBA have posted as well, mate. I'd love your input on that?
Yeah, well, I think this rate decision or this board meeting from the RBA was a pretty straightforward one. I can't think of anybody who thought the decision was going to be anything other than a hold decision, which
Yeah.
of course is exactly what it was. So we've been seeing the cash rate holding at 4.35% since November last year. That was the last time we saw a movement, which was 25 basis point upwards. You might remember that on Melbourne Cup Day. And it's been on hold since then. And generally the consensus is that's probably the last hike back in November. The next movement from the RBA is going to be a downwards one, but it's fair to say there is still some uncertainty. And when you look at the range of forecasts from economists around where interest rates are going to go, the vast majority would have the next movement being downwards.
Yes.
But there are a couple of economists suggesting we could see another rate hike. Sure, they're few and far between, but they generally come from a position of credibility. So it's a fair warning that I think the uncertainty surrounding inflation and productivity and the labor market, all things that sort of factor into the RBA's decision, are still on a fairly, narrow path, as the RBA describes it. From my 2 cents, I think the next move absolutely is downwards, although it's probably not going to be until next year, it seems. So if you look at the big four banks, their economic teams, only one of them, ANZ, thinks rate cuts will be in next year, probably March of next year. The other three think it'll be November of this year. So maybe I'm a little bit more pessimistic, but financial markets are even more bearish, and they're generally pricing at about March of next year now for the first rate cut.
And you think the biggest reason behind that is the current sticky inflation, right? So we saw a decent comeback, like in the first inflationary data that came out. I think it was March or April, but then it went up again, and like there was all the uncertainty around, because it was like the 39 economists came out, right, and put it as coming down, and then the next month the inflation went back up. So inflation is obviously the key driver as to why there's a little bit of imbalance, like you say, that narrow path of which way it's actually going to turn, and obviously the time frame as to when they're actually going to come back as well.
Yeah, this is almost entirely about inflation. There's a few other peripheral things I'll chat about in a second, but
Okay.
You're right. Inflation did bounce back in the March quarter, where currently you've got a headline inflation rate. It's 3.6%.
Yeah.
It's down from nearly 8%, right? So it's clearly on a pretty nice
Definitely
downward trajectory. But it's this last mile, as people describe it, of inflation, trying to get inflation from like 3.6% down below the 3% mark it's proving to be a challenge. And it is services inflation. So services inflation is things like, like financial services, accountancy,
insurances and things.
Insurance, absolutely. Yep. Things you can't really control too much your spending on, but it's also non-discretionary areas of inflation. So think about things like healthcare, education, rents are a big factor of high inflationary pressures as well.
Yeah.
So all these things are looking pretty stubborn. The things we can control our spending on, like discretionary elements, have come down pretty nicely. Households have really pulled back hard for obvious reasons. Cost of living pressures are enormous. So households aren't saving as much. We've got workers like a record number of workers have multiple jobs now. About 7.5% of the workforce is working more than one job. There's not as much being put into savings. We're seeing less being put into offsets and redraw facilities. These are all ways that households and borrowers are keeping on top of their repayments, because we're still seeing mortgage arrears pretty low.
Yeah.
Like that's 1.6% of the loan book would be behind in their repayments, which is still lower than what we're seeing pre-COVID.
It's very low. Yeah. Especially with the sort of interest rate run that we've had over the last couple of years. Can I ask you then, just off the back of that as well, I actually read an article a couple of days ago around the amount of fixed rate mortgages are going to be coming off. Remember that, like the 4 years ago, there was those 1.99s, there's a huge amount. They kind of fixed that in. What are your thoughts around those potentially coming off in the next, say, 6 to 12 months? And I mean, they've been talking about this cliff for so long, right? But in reality, the market's still been charging. But I'd love your thoughts around that, the last of that, 4-year fix at the 199s and all the rest of it sort of coming off in that period. Do you think that's going to have much of an impact on the market?
It probably will have some level of impacts. We've already fallen off the cliff as such. That was sort of June, July last year, where we saw the largest number of fixed rate refinancing happen. Yeah, and it's still flowing through, as you say. And if you we're lucky enough to fix in, it's sort of a 1.9 or even a 1.8% fixed rate. You're going to be refinancing back onto something that's closer to maybe early to mid sixes, maybe even higher than that if you're what a bank might describe as a riskier type of borrower. example. So, I mean, it's a massive jump, but the important thing is this isn't a shock. It's been well telegraphed. Anyone
Been coming for a while.
This is around the corner, and the bank should have been coaching them on what they can do about it. But inevitably, with interest rates higher for longer, with cost of living pressures there, with the labor market loosening up a little bit, there are going to be people that simply can't make that adjustment. And that's why we're seeing arrears rising from their very low levels. I think it would be naive to think arrears won't rise further from here. They will. They'll get back above pre-COVID levels. Yeah. But I think the fact they're pretty low is a really good reflection of the fairly prudent lending standards we've seen in Australia, and the fact that Australians are very accountable and responsible for their mortgage debt. Otherwise, you run into a world of pain. It's not like you can hand your keys back as you can in, say, some other countries. You're generally up for that debt.
Yeah, definitely. I think it's almost like I love your opinion on this as well, but in Australia, it's almost like a pride thing as well. We're not a country that is okay to hand the keys, even if we're able to, or going broke, declaring bankruptcy, those sorts of things. It's something that I think all Australians almost primitively, we all want to avoid that sort of catastrophe as much as possible, right? So they hang on, or they do as much as possible to get themselves through it. And I think, this is my opinion, more people would opt to kind of sell out before getting to that position. I think if they ran the numbers and coming off the 199 into the mid sixes isn't affordable, it's almost like, well, they'd sell and either downsize or rent from that perspective rather than go through that sort of foreclosure side of things, right?
Yeah, absolutely. And I mean, nobody wants to go into foreclosure situation. You generally won't get the best price for your property. And most homeowners or most borrowers are in a solid equity position as well. I mean, we've been seeing so much value growth in the marketplace. Definitely. Fairly small proportion of borrowers are going to be have a property that's worth less than what they owe on it. So I think the other part of it is, we work so hard as Australians to get our foot in the door of home ownership that nobody wants to sacrifice that. And the other option is obviously going into a rental market that's extraordinarily tight at the moment as well. So there's a lot of motivators there, I think, that are keeping borrowers up to date with their repayments. And
definitely,
you probably pull back on everything else you possibly can before running behind.
Definitely. So, mate, if we dive back a second to the RBA meeting today, right, and the key sort of things that were unpacked in that today, and kind of even where they're seeing. So, would you be able to unpack that for us today with what they've brought out there? What do you think their feelings are in terms of, or did they give anything away in terms of what they're thinking of a pullback or trim back or something in the next 6-12 months or whatever? Did they give anything away from that perspective?
Yeah, absolutely. And I think it's fair to say, since Michelle Bullock became the governor, there seems to be a new level of transparency and I guess visibility and understandability that's been coming out of the RBA. Not that Phil Lowe was the opposite. I just think it's been an improvement. So there's a lot of things that the RBA governor or the RBA statement made after the meeting. So there was of course a focus on inflation, which the RBA has been clear. It's uncomfortably high and it's stubbornly high, and there's some things that just aren't really budging, and services inflation, like we talked about. But they also talk a lot about some of the other peripheral factors, like the fact that productivity isn't improving as quickly as what they'd like to. So for your listeners, productivity essentially means, if you divide the number of workers by how much they're being paid, if your cost per unit is going up, then that's a loss of productivity. So what the RBA would like to see is more innovation, more productivity improvements coming through. Some sectors do it pretty well, but like a really bad example would be the residential construction sector that's been seeing this ongoing downwards trajectory in productivity.
And is that because wages increase, from the labor side, from that perspective? Is that?
Absolutely. So you'll find that people are getting paid more for producing the same amount or maybe less. Right? So and maybe it's a reflection of strong unionization and a lot of leverage that you can find in some industries, as well as the fact that the labor force is really tight. So generally, workers are in a good position to negotiate, especially have a strong union behind them.
Definitely.
So some of the other things would be the RBA called out the wealth effect today. You don't see this in every statement, but the wealth effect is simply where they see asset growth, like housing prices, then flow into higher household wealth and give them some level of motivation or comfortability in spending more. It's a very gradual thing, but it is a key risk. And the more we see housing values rise, arguably the higher that risk of a wealth effect kicks in, where households feel more willing to spend, which then drives consumption and keeps inflation higher for longer.
Yeah. So it's almost like that discretionary spending goes up because people feel wealthier, right? And so they're putting more back out there in the marketplace.
That's exactly right. Yeah, they also talked a bit about the household sector being quite vulnerable, quite fragile, and how uncertain it is, what the consumption outlook is going to be. When I talk about consumption, I simply mean spending, right? Like people like you and me, Sam, going out and buying stuff.
Yeah.
There's been a real hard pullback in spending, which is one of the reasons why just economic activity has been so weak. We're seeing economic growth in Australia that's like 0.1% over the quarter. If you adjust for population growth, we've been in a per capita recession over the past 5 quarters. So for everybody, it feels like a recession, even though it's not really technically showing up in the data.
Yeah. Yeah. So just to recap on that, you're saying there was a 0.1% growth GDP, right, during that period, and like 1.1%. I think I was reading the same thing over the past 12 months, which is very, very slow economic growth from that perspective. So that kind of leaves them in a tricky position, right? Because inflation is pulling away with things that we can't control by the spending. So putting interest rates up, we still need our insurances, right? And we still need those things that we can't control from that perspective. But then domestic growth, product growth is lower. So it puts them in this precarious position of, well, what do we do, right? Because if we trim it back, what's going to take off? And then if we let it go further, the growth remains slow, or to exactly as you're saying, they're almost realistically in stagnation or recession if we're not growing from that perspective. So what's the economic outlook from your perspective with this? How do they combat it?
Yeah, so it's such
what are the next moves?
The tightrope they're walking here, right? I think the RBA doesn't want to be in a situation where they have to put rates up more because they know that's going to stifle economic activity and growth and more painful to the household sector, but they don't want to bring rates down too early because they know that if they don't get inflation under control, the long-term effect of high inflation is going to be very negative for households and the economy in the long run. So it's a pretty tight line to walk here. And I think they're waiting, chances are they're waiting for the next inflation data to come out on July 31st for the June quarter. And if we see that coming down again, hopefully the March quarter rise was a bit of a blip. If we see that coming down again, then almost guaranteed that'll be some comfort for the RBA. But if it does hold around that sort of, even gets higher than 3.6% on the annual numbers, that's a bit of a warning sign that the RBA is going to have to push interest rates higher, right? So, this is the uncertainty that we're facing, and probably keeping consumer sentiment at such low levels. And we've been seeing sentiment extremely pessimistic for more than 2 years now, which is quite the rarity.
Yeah. No, I agree, man. That's crazy. And so the idea, obviously, is from this point, you're probably going to see a wait and hold for now until that inflationary data comes out. And then from the sounds of it, that's going to obviously be the very telling factor as to what happens the rest of the year in terms of what happens with interest rates. I mean, if it's hold steady, maybe they just hold steady until the next inflationary data, right? But if it's up or down, that's where, we might get some decisions made off the back of that as well.
Yep, that's exactly right. But I think the central scenario is probably interest rates are on hold until at least November this year, probably into early next year would be my base case.
Okay, awesome, mate. So to recap on that, and your opinion on this, your bet on this is probably early next year. I think you said February to March at the start. That's your call on where you think it's coming back.
Yep.
Okay, awesome, mate. Perfect. It'll be really interesting to kind of monitor it, and see how everything turns out from that perspective. So I won't hold you to it, but mate, I know we're having a squeeze. But mate, I always love getting a bit of information about that's the interest rates done and dusted, and having a good chat about that. I'd love to know your opinions on the market moving forward for the rest of the year. I read an article that you wrote a couple of weeks ago as well, in regards to a lot of the market right across the country is still quite tight from a stock level perspective right now, but then a few are blowing out. What's your opinion, mate, on those couple of areas and regions that are blowing out stock-wise, and then also maybe your opinion moving towards the rest of the year as to where's going to outperform from that perspective, growth perspective?
The listing numbers are absolutely fascinating and arguably one of the most important facets of the market at the moment. Definitely. So we are seeing vendors becoming a little bit more active. Pretty much every capital city is now seeing the number of new listings coming into the market is higher than a year ago. But probably the more important aspect, rather than that flow of stock coming on the market, is the total inventory count, which gives you an idea of how much of that new stock coming to market is being absorbed. So there's a few markets where clearly there's an accumulation of advertised stock building up. So Hobart's the clearest one. Not that Hobart really pushes the headline numbers around at all. It's a small city, but anyway, we've been seeing listings in Hobart about 40% above average for this time of the year
Wow.
for a couple of years now. But Melbourne's really emerging now as a market where stock levels are holding consistently at above average levels. So our latest data, we generally count listings on a rolling 4-weekly basis.
Okay.
This helps to smooth out some of the week-to-week volatility.
Definitely.
So Melbourne's sitting about 17% above average now. So
when you say above average,
Tim.
Didn't mean to cut you off there. When you say above average, you mean probably compared to this time last year or compared to the rolling average?
Yeah, compared to the previous 5-year average is what we generally look at. So when you look at listing numbers, it's really important to compare back to the same time, like say a year ago, or if you're using the average, we're still looking at sort of the middle of June, because it can be really seasonal. But we prefer to use the 5-year average just because it sort of smooths out some of the lumps and bumps. Arguably, the 5-year average isn't really a relevant benchmark anymore. You can go back 10 years, but then you're starting to include things like macro-prudential policies and the Royal Commission. So it's really hard to find a reasonable benchmark to use. So we're sticking with the 5-year benchmark at the moment. It's and it seems to be a pretty good indicator for most markets. Like somewhere like Perth is 45% below the 5-year average at this time of the year. So Melbourne's standing out. So is Hobart. Sydney's pretty much bang on average levels, fairly balanced. Darwin is always a bit volatile, but also above average. So is Canberra. So then you've got your sort of mid-sized capitals, Perth, Brisbane, Adelaide, where stock levels are remarkably low, like 35% to 45% below average, and not really showing any signs of starting to rise, even though vendor activity is stronger than normal. So this tells me that demand is enough to keep up with that new supply. And of course, it helps to explain why we're seeing this persistent and very strong upwards pressure on housing prices in those markets.
Definitely. How do we see the turning point? Or with that, is that just a matter of really tracking it from that perspective of that 4-weeking averages and keeping on top of it from that side? Like, how would most people stay on top of that to either see the change in, say, cities like your Perth, Adelaide, and Brisbane, and then the same way of maybe even picking the bottom of the other bigger capital cities? Well, it sounds like Sydney's just sitting at a bit of an average across it, right? But even say like your Melbournes and whatnot, and picking the bottom of that, because a lot of people are starting to talk about Melbourne again as well. Is that something? Is that probably the predominant factor you'd be having a good look at here, or what are the biggest things to, I guess, call either way in terms of that market?
Mate, it's hard to pick the bottom of the top of the cycle. Easy in retrospect, absolutely.
Hindsight's a beautiful thing, right?
I think it's a matter of luck in most cases if someone does pick it. So the things we kind of look for would be, absolutely, the listing numbers are a really critical one. Any sort of high frequency update, like listings are updated weekly. You got your clearance rates, although I'd say outside of Sydney and Melbourne, they're less relevant because you don't see as many auctions in other markets. You'd also look for things like some of the private treaty metrics around how long does it take to sell a property, what sort of negotiation or discounting rates are in play. Although those numbers are more monthly, and we tend to aggregate them on a 3-monthly basis even to smooth them out. So the inflection points can be a little bit hard to pick. We have a high frequency value index as well. That does seem to pick the turning points in the marketplace pretty well, but sometimes it's hard to understand what's a real turning point and what's just some volatility you're seeing in the reading. Again, just kind of highlighting that the retrospect aspect of picking the bottom of the market is a lot easier. Then there's other things you can look for, like external data sets around housing finance numbers. You can look for any change in policy. Like, it was really clear back in 2014 and 2017 when APRA brought in some macro-prudential policies.
I remember.
Almost instant effect on the market. Simply highlights how important credit availability and access to credit was. And then the Royal Commission, same sort of thing. So there's no one silver bullet or key thing we look for in the marketplace. It is a combination of things, and ultimately you probably start to see it in things like valuation estimates and the time on market and stuff like that. But logically, it is hard to pick in real time.
Yeah. Yeah, man, no, I couldn't agree more. It's one of the hardest things with it. It's always lag data as well you're working off, right? So like you can track it as closely as you can, but ultimately it's lag data. So if you see something either coming back or tightening up or whatever it is, it's always after the fact of when it's first happened. So as like you said, when you pick it's funny when you say that about picking like exiting something, it comes or picking something perfectly at the bottom or the top, it comes down to luck. I sold out of my very first unit I ever bought in mid 2017. And I always say it was just the luckiest decision of when I exited that thing, because it just happened. It was July 2017. It was literally the peak of Sydney market. I just fluked it, So sometimes it's just luck that comes into it. You can time as close as you can, but it sometimes can have a pretty big impact on it as well. So, mate, to wrap up, I'd love, by the way, thank you so much for all this information as well, mate. It's really good to unpack this, but I'd love to know, mate, what's your opinion on the market moving forward for the rest of 2024? Obviously, we're in an extremely tight stock position right now. The interest rates don't really seem to be impacting too much across the board. We've still got really strong population growth, super tight vacancies. What are your predictions, mate? Where are you kind of seeing the market heading and yeah, for the rest of the year, final 6 months of 2024?
Yeah, again, it's hard, right? So I'm trying to forecast anything is hard at the best of times, let alone when things are so uncertain. But I think one thing that looks really clear to me is that values are going to continue rising across most markets. And this is very much a supply side issue, not as much on the demand side. We're definitely seeing, we've moved through the peak of population growth now, migration's winding down to more normal levels. But we're not seeing a supply response. And that's probably not going to happen until probably the middle of next year, when we start to see more capacity constraints being unleashed from the building sector. Hopefully the established market has risen enough to see builders being able to stack up their feasibilities and deliver stock to the market with a premium and a profit associated with it. That's the biggest challenge at the moment. So I think at least the next 12 months is going to be characterized by further growth in housing values. Probably not as quick as what we've been seeing over the past year or so. We're starting to see some barriers in the market, like affordability constraints. Lending environment is still pretty cautious. Of course, cost of living pressures are hard. Rental markets are still just very, very tight. Rents are still rising quite quickly, which makes it harder to save for a deposit. So with all those things in mind, my guess is we'll continue to see fairly similar trends as what we're seeing now, probably a gradual slowdown in the pace of growth, but also a lot more diversity as well. Markets like Melbourne, as you mentioned, I think are going to be relatively soft going forward for at least the next 6 to 12 months, but that's building up its own competitive advantage. So it's one of the few capital cities that's becoming more affordable. It's one of the few cities where yields are actually rising as well. So you'd have to think over the medium term, that's going to become a lot more, attractive for investors. The fact you can buy into that market and lower price points, and your rental return is going to be pretty decent as well.
Yeah, for sure, mate. It's been an a very interesting one to watch. I think with obviously the land tax reform and what they've changed there, we've seen so many investors, personally that we work with, exiting out of investments that have done well out of from a growth perspective, but it's just becoming more expensive to hold because the yields were so low, and then they're selling out. So the market's just getting tighter and tighter. They saw a lot of the international migration coming in as well. So then there's that pressure cooker finally on the rental side for Melbourne and for Victoria to start to pick up. So, mate, I'm with you. I think it's a watch and wait one. I definitely believe now is probably that bit too early, but it's going to be interesting to watch how that plays out, exactly as you say, the next 6, 12 months and beyond.
Yeah, time will tell, hey, and let's keep an eye on the data.
That's it, mate. That's it. Well, mate, speaking on that data, thank you so much for jumping in and sharing all your research and studies behind it, mate. We'd love to get you back on to unpack potentially even the next RBA meeting, because I'm pretty sure that'll be also after the next inflationary data. So, mate, it'd be amazing to get you back on, unpack the next one as well, mate.
Sounds good, Sam. Thanks for the invitation, mate.
Tim, thank you very much for joining us, mate. It's been a pleasure.
Cheers.